Matt Kirk from toptraderthinking.com, and in this webinar I'm going to run through an introduction to trading futures. So what are futures? We'll start with that. Futures are contracts traded on an exchange with standardised specifications relating to quantity, quality and expiry date. They are initially designed for producers and end users to hedge price risk. The main users in today's markets are speculators, and in futures, anytime you like, you can actually sell or short sell before you buy. So what are some of the contracts that you can trade? Well, stock indices, so the share price index, which is the futures contract on the All Ords in Australia, the S&P 500 and the Dow Jones, both American, the FTSE, which is London, the DAX, the German market, Nikkei in Japan, we trade that out of Singapore predominantly, and the Hang Seng. Interest rates, in Australia there's the 3 and 10 year bonds, 90-day bank bills. In the US you can trade 5 and 10 year treasury notes, 30-year treasury bonds. Then of course in other countries, in the UK for instance, there's the 10-year bonds and the Japanese JGB, which are 10-year bonds as well. Then of course there are currencies, so the Aussie dollar, Japanese yen, the pound, euro, Canadian dollar. And in food we've got things to trade like the grain markets, so wheat, soybeans, corn. In the meats there's pork bellies, lean hogs, cattle. Energy markets and metals, we can do trading in crude oil, heating oil, natural gas, gold, silver, copper. And the other markets in the food include coffee, sugar, cocoa, orange juice. Then there's fibre, which is wool and cotton. So as you can see, there's an absolute huge range of markets that you can actually trade with all different characteristics. As I said in the intro, futures contracts are standardised. So each has a contract unit and what's referred to as a tick size. And tick size is the minimum price movement for each contract. So let's use the share price index, or the SPI as it's referred to, which is the futures market in Australia on the All Ordinaries, or on the stock market. Now, the SPI futures is 25 times the S&P ASX 200 index. Now what this means is a 1 point move in the SPI futures equates to 25 Australian dollars per contract. So let's say we're in April 2009, the SPI was travelling around about 3,500. So if you'd bought one SPI contract at 3,500 and the market moves to 3,510, so a move of 10 points, you've made a profit of $250. That doesn't include commissions. Now, the S&P ASX 200 covers approximately 78 or 80% of the Australian equity market capitalisation. Another market, or another example we could use in the US market, is cocoa. Cocoa is a 10-tonne contract, so a move in cocoa of $1 equals 10 US dollars. So let's say you've sold cocoa at 2,300 a tonne and the market rallies, so it goes against you by $10. So in that particular example, you've actually made a loss, an unrealised loss, of 100 US dollars. So let's take a quick trade in the SPI at the moment. Let's say it's the 9th of April and your analysis suggests that the Australian stock market will rally over the next couple of weeks. So remember again, each point per contract in the SPI is $25. Now the SPI as well trades calendar quarterly. So if we're in April, we'd be trading the June contract. So it also trades the September, December and March contracts. But for this exercise, we'll be trading June. So you buy one June SPI at 3,500. You place a stop loss, let's say a 40-point stop loss at 34.60. So you're risking 1,000 Aussie. And the market does rally, your analysis was correct. So in 10 days, the SPI is now trading up 100 points from where you bought at 3,600. So at that point, you could take the profit. So you would sell your one June SPI contract at 3,600 and you've made a profit of 2,500 Aussie, not including commissions. Commissions work out, by the way, around say $20 or $25 to buy, and same to sell, plus GST in Australia. Now at that point, you've bought one SPI, you've sold one SPI, you've taken your profit of $2,500, you've got no position left in the market. That's referred to as being square. Now let's have a look at trading some cocoa in the US market. Exactly the same thing. You either place this trade in America on your platform or with your broker during the day or at night time. It's the same thing. Then the contract is simply transacted on the American market. Now, once again, each $1 move in cocoa is 10 US dollars. So this time we'll go short cocoa. So let's say you sell one May cocoa at 23.20. You place a stop loss $60 above at 23.80. So in that case, you're risking 600 US dollars. So in this particular instance, you are correct, and cocoa has fallen down to 21.20. So again, sold one at 23.20, cocoa's fallen $200. You buy it back at 21.20, times 10 is a profit of 2,000 US dollars. Once again there, you're now square in the market, you have no position in the market. Now those sorts of trades the time frame, I guess, could be anything from hours if the market's moving, having big moves, or that could be a number of days, or even a couple of weeks or so. But those moves happen all the time, and they're more than possible in the market. Now, people talk, you might have heard about high leverage. So in the SPI and the cocoa trade, I'll give you an example of, I'll tell you exactly how much you were trading. So the SPI contract, for instance, just buying one meant you had an exposure in the market of $87,500. So you're effectively buying 87,500 Australian dollars worth of the basket of stocks. How do we get to that? Well, with the index at 3,500 and $25 a point, that equals your 87,500. Obviously, if the market goes up to 4,500, that's going to be close to a $100,000 trade. Now, same with cocoa. In cocoa, one contract, we're effectively trading 23,000 US dollars worth of cocoa if cocoa's at $2,300 a tonne. So that's how the leverage works. Now, you also probably heard about margins and deposits. So what's all that about? Each contract that you trade or open, whether you short, sell or buy first, you have to put up a certain amount of money. Now that's called the margin or the deposit requirement to open the position. Now that particular amount of money is set by the individual futures exchange and is based on the volatility of the market. The more volatile the market at the particular point in time, the higher that margin will be. The exchange can change the margin requirements at any time. They tend to only change them, not very often, just when that volatility becomes excessive. When the volatility then goes back to, say, normal, then the margin might come back to what it was previously. Now that margin is paid to your broker, so it comes out of your account. For instance, in the SPI in April, the requirement was 8,000 Aussie dollars, and in cocoa, you're looking at about 1,800 US dollars to trade one cocoa. And like I said, all of these contracts have different amounts, so if you need further information on that, certainly let me know and we can run through that together. Well, that's a good intro just on futures. I'm Matt Kirk from toptraderthinking.com, and like I said, if you'd like further information on trading futures, then let me know.